Today we're going to go over the top 10 tax deductions for real estate investors. What I'm focusing on are the deductions against rental income. The scenario where you own a rental property, you are a landlord and you rent it out. Number 1, repairs. Repairs are the first deduction. If you have rental income, you can offset it with repairs. These are repairs you make to keep the property in good operating condition. Think of it this way. Individuals earn money, pay taxes, and then spend what's left over. But businesses earn money, spend it, and then are taxed on what's left. In real estate, you get the full dollar of rental income and then reduce your taxable income by deducting your expenses. Repairs reduce your taxable income, but there's a big difference between a repair and an improvement. If you remodel a property, that's an improvement, not a repair. Improvements must be added to the property's depreciable basis and written off over time. There's a safe harbor rule for repairs. If a repair costs less than $2,500, you can write it off as a repair. If you're keeping financials for loan reporting or other purposes, the safe harbor doubles to $5,000 per repair. Next, number 2, property taxes. Unlike individual taxpayers, real estate investors can write off property taxes and don't have to worry about the SALT, state and local tax limitation. Number 3, professional fees. Professional fees include paying for professional services, such as accounting fees and legal fees. For example, if you have to pay an attorney to evict a tenant, you can deduct this expense. Number 4, wages, independent contractors, and management fees. You can deduct expenses for paying a handyman to work on the property. Additionally, if you have a property management company managing your property, you can deduct this expense. Next, depreciation. Depreciation is the biggest non-cash deduction. You get to write off the cost of your property over its useful life. For a residential property, that's 27.5 years. For a commercial property, that's 39 years. However, the IRS requires you to break this down properly into components. For example, appliances use 5. A cost segregation study can help you maximize depreciation deductions by identifying shorter-lived assets. With bonus depreciation, you can write off a significant portion of your property in the first year. Number 6, mortgage interest. Mortgage interest on investment property is fully deductible. There's no limit, unlike the mortgage interest deduction from primary residence. Even if you use a home equity line of credit on your primary residence to buy rental property, the interest on that HELOC is deductible. Number 7, capital gains exclusions. When you sell a personal residence, you can exclude up to $250,000 in capital gains if you're single, or $500,000 if you're married. But for investment properties, you can use a 1031 exchange to defer capital gains indefinitely. A 1031 exchange allows you to sell one property and buy another without paying taxes on the gains. As long as you keep rolling the gains into new properties and don't sell for cash, you avoid paying capital gains taxes. Number 8, active participation as real estate professional status. If you qualify as a real estate professional or have active participation in real estate properties, you can be eligible to offset passive losses against your W-2 wages. This can be a game changer for high earners looking to reduce their tax liability. For example, say you earn $200,000 in your W-2 income and have $30,000 in passive rental losses. If you meet the IRS qualifications, you can use that $30,000 in losses to reduce your taxable income to $170,000. This can result in significant tax savings, especially for those who are in higher tax brackets. To qualify as a real estate professional, you must spend at least 750 hours annually on real estate related activities and ensure that more than half of your working time is devoted to real estate. Often, our clients have their spouse claim the real estate professional and offset it against their W-2. Number 9, the home office deduction. If you have a dedicated space in your home for managing your real estate business, you can take the home office deduction. And finally, number 10, paying your kids. You can pay your kids for helping you with your real estate business. And if they're under 18, you don't have to withhold employment taxes. If their income is below the standard deduction, they won't owe any taxes. This is a great way to move money from your taxable world into a tax-free world. For example, you can pay your kids for social media work, cleaning properties, or helping with administrative tasks. It's a legitimate business expense and a great way to teach your kids about money. I go into this in more detail in my video on the 3 secrets to hiring your kids. I'll link this video here. These 10 deductions can help you significantly reduce your tax liability as a real estate investor. If you're not taking advantage of these deductions, you're leaving money on the table.